Thus far, we've focused the most on the mechanics of credit spreads. That's because understanding how to sell options is an important aspect of Level 3 trading. Next, we'll dive into debit spreads. As we mentioned earlier in this series, when buying an option, the investor generally needs a large move. Often, that move needs to be more than what the options market is expecting. But by turning an outright option, like a call or a put, into a call or put debit spread, the buyer can lower the cost of the trade and create a break-even closer to where the stock is trading. The trade-off is that the spread has a max gain after a certain sized move. Before we get to examples of debit spreads, let's discuss the expected move, because it's particularly illustrative here. One way to think about the expected move is if the stock stays within the expected move, options were overpriced. If the stock goes beyond the expected move, options were underpriced. And if the stock stays in line with the expected move, options were properly priced. Knowing this consensus before making a trade can be incredibly powerful, particularly with strike selection, and especially on spreads. Now back to call spreads. To recap, a call spread is a directionally bullish strategy that buys a call while simultaneously selling a higher strike call within the same expiration. Now let's bring the expected move into this example. In our example, the stock is trading 100. The expected move for the next month is 5%. That means a bullish consensus of 105 and a bearish consensus of 95. If we were to agree with the bullish consensus of around 105, we could buy the at-the-money 100 call for $3. That gives us a break-even of 103 and the potential to make up to $2 if the stock goes to 105, and the potential for more above 105. But if we don't want to waste money positioning for a big move and want to position for a move in line with what options are pricing, we could turn that call into a debit call spread by selling the 105 call at the expected move at $1, and therefore reducing the cost of our trade by $1. In doing that, we've created a debit call spread to the expected move that costs $2 with the chance to make up to $3. And we've lowered our break-even by $1 from the outright call. Beyond 105, the trade's profits are capped, but that move is beyond what the options market is expecting. And our goal here with the call spread was to reduce cost while increasing our trade's probability of profit.
Trade on a new breed of brokerage. Trade smarter with Options AI.